Hello, everyone, and welcome to this first ever webinar hosted by Calcbench to explore financial reporting issues and the data analysis you can use to understand them. I'm Matt Kelly, and I'll be your host and moderator today. We are delighted that you could join us. Today's webinar is probably going to run about 40 minutes, and it's going to be divided into two sections. First, I'm going to interview our guest for today, Marc Siegel. He is a former longtime member of the Financial Accounting Standards Board. Marc will talk to us today about the evolution in financial analysis that he's seen over the last decade and give us some examples based on current financial reporting issues that are on his mind. And then we are going to shift gears in the second half to where Calcbench is going to walk through some of those examples again, demonstrating how you can use its data analysis tools to find information about corporate filers that might help you better understand what it is they're reporting. Two housekeeping details before we begin. First, this webinar is recorded, so we are not taking live questions from listeners today. But if you do have questions, we're eager to hear them. So feel free to email us at info@calcbench.com, and one of the team here will reply to you within 24 hours. And second, this webinar does not offer any continuing education credit. We're sorry about that. We would like to, but we do not. So that's all the housekeeping. And now we can get on with the first half of our program. As I mentioned earlier, our first guest today is Marc Siegel. Marc is a former member of FASB, and he served on the board for 10 years, from 2008 until this past July. Prior to his appointment to FASB, Marc led the research team at the Center for Financial Research and Analysis, which ultimately became part of the Risk Metrics Group that is based in Maryland today. And back in the 1990s, Marc worked at Arthur Andersen as an auditor and a financial consultant. We should also note here that the Center for Financial Research and Analysis, that was the group founded by Howard Schillett. He is the author of the book Financial Shenanigans that many of you might have on your shelves. And Marc was one of Howard's lieutenants, where they spent plenty of time poring over information in financial statement footnotes, looking for all of the juicy stuff and pulling out all of the best insight. And I suspect nosing around in the footnotes is going to figure in our conversation today. We should also note, just for the record, that while Marc was a member of FASB, it is important to note that his comments today are his own. They do not represent anything about generally accepted accounting principles or the views of others in the FASB organization. He is not part of that organization anymore. So, with all of that said, Marc, welcome.
Thanks very much, Matt. Thank you for having me.
So, first question here. You've been in financial analysis for more than 25 years now. Just talk to us about how has that job changed, maybe even especially in the last 10 years when we've seen the power of data analysis really kind of catch up to the analysis that people have wanted to perform. What's going on?
I think the biggest change that we've seen in the last any number of years has really been just the breadth and variety of information that's available to financial statement users, to analysts, and to investors. Everybody talks about the volume of the financial statements and the 10Ks and the annual reports increasing, and of course they have. The volume of those documents have skyrocketed, particularly over the last 10 years, but even before that. But in addition to just the size and sheer volume of the financial statements, the voluntary disclosures that company puts out have also increased significantly. There was a study from a couple of years ago done out of Wharton called Disclosure Through the Fog, Guiding Through the Fog out of Wharton. And it really just highlighted for the first time that I've seen just the volume of non-required or voluntary disclosures over time. And that too has increased 30-fold. So with all that, how do investors try to figure out what's the most important thing to look at, and looking through all that information and analyzing that data is just a significant crunch on their time.
Mm-hmm. So give us an example of what you mean. Maybe some issue that intrigues you as an analyst that we are becoming better at finding today thanks to analytics technology, or something else along those lines.
I think the biggest thing that I think about day in and day out is really, because of all this information overload that there is, just trying to figure out where are the inconsistencies between those different data communication streams. So, for example, I think that oftentimes people look at the story that's being told by management in their earnings releases and in their investor roadshows and in the front half of the annual report. And that information is phenomenal. It's terrific. It really talks about what management's insights are, et cetera. But then you also have to look at the required financial disclosures in the 10Ks and the 10Qs and see what the story is that's being told by the footnotes. And frankly, that's the only audited information there is out there. And so when you find inconsistencies between the story that's being told by management and the story that's being told by the financial statements and the footnotes, then as an investor, that's when you start asking questions and raising red flags. So, there's plenty of examples of that. I think one of the biggest things, that you might find is potentially looking through the quality of earnings, and a company might be reporting huge increases in quality of earnings, but through data analysis and looking through the footnotes, you might find things such as roll forwards of key reserve accounts like warranties or allowance for doubtful accounts, or even significant drivers of revenue growth that might have been not highlighted as much in the earnings release, but you could really see what's going on in the footnotes. And so I'm happy to talk through some examples even in more detail than that. But that's really those inconsistencies where you find between, say a company might be talking about how green they are in their earnings release or in their annual report in the front half of the annual report. But then in the back half of the annual report, you see in footnote 23, all the different Superfund sites that they are cleaning up. And it's those kinds of things that raise red flags that investors have the now easier ability, rather than just brute force reading through all these documents and trying to find and highlight and bring to bear on the company.
So let me just ask for some historical war stories then, before we get into the nitty gritty of, say, roll forwards or warranties. And I want to get to those in a minute, but you've been doing this a long time. So how would you have been doing this, say, in, I don't know, 1998 or 2001 or something like that? How much hair pulling or, glazed eyes over the footnotes in printed documents? How much of that were you doing?
Yeah, no, it's brute force, right? It's sitting in a cubicle. 1998, you may or may not have had the information up on the internet where you actually could find the filing. You mentioned Howard Chillett. When Howard Chillett founded CFRA, he used to have to go down to DC and actually dig through the archives and the SEC's archives and find the annual reports there. But once you had even when you had the documents online on the internet in Edgar or on the company's website, you still didn't have the ability to really parse through it. And so what I used to do is, frankly, print them out, read through them. Sometimes I would create my own word compares, where I would take the critical accounting policies from last year's 10K and the critical accounting policies from this year's 10K and copy and paste them into Microsoft Word and try to do a word compare and create my own redline version to try to find places where there might have been a change in accounting policy that might not have come across that way, or you might just get an insight that no one else has found. That's how it used to be done, and that's why not so many people would do it, right? Because who has the time or the inclination to go through that kind of analysis? But now it's becoming easier if you have the inclination to look for those inconsistencies.
Okay, and so just like over the last 10 years, then how interested in or how much have you really been trying to push for these advances in machine readable technologies? Now, it's no secret, Calcbench uses XBRL, one of those technologies, to bring the analysis here, but how much has that sort of been weighing on your mind as we got to get this right to be able to bring more analytical power to the investing and financial analysis masses?
Well, the more information that's out there for investors to look at, the better. However, it needs to be in a format that facilitates that review by the analysts. And that's where things like roll forwards and things that we heard at FASB over and over again from analysts are tabular formats make things easier to understand, as opposed to having numbers that are buried in narrative. if you could put it in a table, it makes it much more easier for the analyst to comprehend, and frankly, the ones who are dealing with it electronically could much more easily download it into a format that's going to make it easier for them in, say, Excel.
Mm-hmm.
Of course, preparers had views about that it was more costly to use roll forwards, because then they had to sort of prove out every penny from the beginning to the end. It was much easier for them to sort of disclose things qualitatively without so many numbers. So sometimes, as a standard setter, you have to sort of weigh the costs with the benefits of things. But from the perspective of the analysts, time and time again, they were saying more consistent data across time, more comparable data from company to company, and where possible, do it quantitative and in tabular format so that it would facilitate the review of the analyst.
Okay. So now let's get back to those nitty-gritty examples that you'd mentioned from time to time here. I don't know, I'll give you the player's choice here, whether you want to talk about warranties or segment reporting or roll forwards of accounts or something like that. But give us a example of how you would try to do that sort of analysis today if you're looking for an inconsistency. What do you mean?
So the best example, let's do an easy example, like the allowance for doubtful accounts.
Mm-hmm.
And this is basically just a reserve that goes against every company's accounts receivable. And you look at that to sort of get a sense of how much of the accounts that are receivable of a company, how much they've sold on credit, how much of that do you think is going to go bad in terms of bad debt? And you look at the roll forward, because the roll forward tells you not only the beginning balance of the allowance and the ending balance of the allowance, but what happened during the year. Maybe, for example, they reduced that allowance during the year, which the only way to really do that is to reduce their bad debt expense in the current year. And if you have a lower bad debt expense this year versus last year, all else equal, your earnings are going to be better, right? It just stands to reason. So when you look through roll forwards, you're able to see over time what the balance is of the allowance for doubtful accounts. You're able to compare it to the gross accounts receivable. You're able to sort of see, has the company reduced its coverage of its accounts receivable with its allowance for doubtful accounts in such a way that it increased its earnings in a given year, not because they had better operations or anything, but really they just changed their assumption of how much their doubtful accounts are going to be going forward. Mm-hmm. Now, as an analyst, I look at that and I'm not really trying to make an insight about whether or not the company is accurately reflecting that or not. I don't know whether they've got less collectability issues than they did in the past. But what I can say with relative certainty is that the allowance for doubtful accounts is not going to go through zero. So any growth in earnings that the company might have gotten this year, just simply by reducing its estimated bad debt reserve, that growth is not going to compound over and over again and deserve a terminal value when you're doing evaluation. Mm-hmm. So if they got 2 cents in the given year of EPS because they lowered their reserve for doubtful accounts, all else equal, don't bet on that being 3 cents next year and 4 cents after that. You have to sort of normalize those things out. And those are the things that roll forwards can help you find, whether it's a warranty reserve roll forward or an allowance for doubtful accounts roll forward. And that's why analysts consistently tell us wherever possible we should give them roll forwards to help them in their analysis. And it really helps with quality of earnings issues.
Okay. So we've got about 5 or 7 more minutes here. Can I switch gears to 1 or 2 significant accounting standards that are bearing down on analysts today and how they should think about them?
Sure.
So I'll pick 2. Revenue recognition, which was a big change that went into effect at the end of last year, and lease accounting, which will be a big standard change going into effect at the end of this year. I'll start with revenue recognition. We have the new standard. It's now in effect. Companies have been reporting under it. How might that standard have anything like a distorting effect on what gets reported? Or could companies even try to, game the new standard for what they might want to report? What should we be aware of or think about?
Yeah, this was a pervasive change. It affected every company. Whether or not it actually affected the top line at the end of the day, really varies by industry.
Mhm.
But every company had to go through a huge process to sort of understand what the effect of the new revenue standard was. The benefit for investors is it's going to be the same kind of paradigm, the same approach, industry to industry. When you go from one industry to another now, you will not have to learn how revenue works in a different industry. So that's helpful. But the impact in 2018 from the change is going to vary by industry, and even within industries, it's going to vary by contract type. So for example, in defense contracting or aerospace and defense, we saw some companies report not much change at all in their revenue year over year. However, on the other hand, we saw other companies in that same sector who do their estimates differently had to have significant changes. So even within an industry, there could be changes based on contract type. From an analyst perspective, trying to understand these things, you're going to have to look at multiple companies in your industry and see how they're reporting to see why there might be inconsistencies and whether those inconsistencies make sense. Also, in terms of looking at the same company consistently from one period to the next period is much more difficult anytime you have a change. And we had to, at the FASB, provide two different ways of transitioning to this change. So some companies would change by means of a retrospective approach, which means they restated all their old numbers, and that gives the analyst the best approach to understand their revenue trends over time for a given company. Other companies transitioned using a modified retro approach, which means they did not restate prior years. They only started doing it in 2018, but during 2018 in the footnotes, they are required to disclose what their 2018 revenue would have been under the old revenue method. So one way or another, either under the new method or under the old approach, you should get at least an apples to apples comparison of what revenue would have been from last year to this year. It might not be the same apples to apples approach, might be one where both last year and this year are under the new method, or another company is last year and this year are under the old method, but you'll get some kind of consistency.
Okay.
Now, one other important thing to point out, though, is that since you don't get a retrospective balance sheet, even if you did the retrospective approach, many analysts try to look at things like days sales outstanding. But since you don't get a restated balance sheet, those metrics are going to be out of whack when you compare the 2018 numbers to the 2017 years. So this is going to be a significant issue, and just be careful as an analyst.
And then lease accounting. We have the new standard for accounting for operating leases. That goes into effect at the end of this year. That will put all of the costs of those operating leases onto the balance sheet as liabilities. So how would that, and putting the value of the operating leased assets onto the asset side of the balance sheet too, how could those things affect financial operations as well? Again, what should we be looking for?
So again, here industry matters, right? So retailers are the big obvious ones where you've got all the stores are going to all the operating leases for the stores are going to come on balance sheet, and that's obviously the big player. Calcbench actually recently did some work looking at who the different companies might be that might have an impact, and so that's something else to look at if you're an analyst. The obvious answer to what the impact is going to be is higher leverage ratios. As companies add more leases to the liability section, their debt to equity ratios are going to increase significantly. But also, you should be aware as an analyst there are some nuances that you got to take into account. You should be aware that renewal options and contingent rents are generally excluded from the liability. And maybe that's okay, maybe that's not okay, but you just have to understand that. So if you're looking at a company that's got operating leases and they frequently renew, that might not all be included in the liability. Or if you've got a company that the rents are based on a percentage of sales, that's not all going to be included in the liability either. So the liability may not be fully inclusive of everything you might assume it is, and so you need to be aware of that. The other thing to be aware of is that IFRS, the international reporting standards, differ in certain ways from US GAAP. Under IFRS, they have only one type of lease going forward. All leases will be treated like capital leases are today. In the US, we retained having two kinds of leases, operating leases and capital leases. So if you're comparing a company in the US versus a company abroad, you just need to be aware that they're not exactly comparable, and you've got to dig in a little bit further.
And what about putting the value of the leased asset on the asset side? Or there might be implications for how you calculate return on assets or assessing the value of that asset over time that you've already been paying for on the liability side. Any issues there?
No, that's a great point too. And again, that varies by industry. Those assets, right, will be, if you're doing a return on assets calculation, those assets are going to reflect differently than they did in the past because those assets were not included on the balance sheet. You also now have to look at potentially impairing that asset where you didn't have that asset on the books to begin with. Also, for operating leases, it's kind of a weird amortization approach that is being done to sort of write that asset down. It's not a typical, okay, I see this asset here and I'll write it down straight line over the life. In order to maintain sort of a straight line income statement approach for the lease expense, we sort of did a reverse amortization of the lease asset, which is really going to be opaque and not necessarily important to the analyst. But don't if you're focusing on the asset side, first of all, it's usually not collateralized, and it isn't going to come down period over period in a straight line way that you might expect another asset to.
All right. Well, Marc, that's all the time that we have today, but you gave us plenty to think about here and covered a lot of ground. So thank you very much for your time.
Thanks very much for having me. I really enjoyed it.
And again, everybody, that was Marc Siegel, former board member at the Financial Accounting Standards Board, joining us today in the first half of this webinar to talk about financial analysis and some current financial reporting issues. Now we're going to shift gears to the second segment, exploring how you can use Calcbench data analysis tools to look at some of the very issues that Marc was just talking about. Our next guest is Pranav Ghai. He is co-founder and chief executive officer of Calcbench. Pranav manages the day-to-day operations of Calcbench, and he has more than 20 years of experience in financial analysis. He previously worked at TIAA and ITG, and he was vice president at Morgan Stanley, where he was in charge of modelware and quantitative and derivative strategies there. In addition to working at Calcbench today, Pranav is also a board member of XBRL US, and he's on the Technical Computing Advisory Board for Microsoft and a member of the CFA Institute's Corporate Disclosure Policy Council, and that's a body that addresses issues affecting the quality of financial reporting and disclosure worldwide. So, Pranav, welcome. Thank you.
Hi, Matt. Thanks for having me.
Sure. So before we get into specific thoughts about what Marc Siegel was just talking about, give us the elevator pitch on why Calcbench is so useful for financial analysts and some of the features and capabilities you think are most important.
Oh, sure. So the Calcbench comes out of a host of different needs that both Alex Rapp and I saw when we were in our respective lives prior to starting the company. So we had access to all the tools that were available to financial analysts, 10 years ago, Capital IQ, FactSet, SNL, all of them. And so we found that even with the best tools, there were always things missing. So when we started Calcbench, we set out to change a lot of that. And Calcbench, through its use of XBRL, allows an end user or financial analyst, whoever, whatever your purpose is, whether you're reporting something to your CFO as a corporate financial analyst, or whether you're making a buy-sell decision in an investment management firm or on a sell-side brokerage house, we let you go down into the gory details of the financial statement, into the footnotes, and ask questions that people have been asking for a long time, for 100 years, since financial statements were started. but we let you do it in a very modern, fast, and clean way.
Mm-hmm.
So things you can do are, you can do simple things like ask for sales of a company in history, revenues, for example, over the last 5 years, 10 years perhaps. But you can also do things like, well, what were my company's sales to China or to Turkey, or what are my property, plant, and equipment exposures overseas? And you can do that literally with a few mouse clicks. And these are questions that people ask all the time. And so
Okay.
we've given people the ability to get answers at with a mouse click.
So we have a couple of examples here that I know you want to walk through. And the first one that you wanted to discuss was about tracking changes in accounting policies. And let me note, I have had board directors and various other elder statesmen in corporate governance. They've always told me that changes in corporate accounting policy, what is a company changing? When are they changing it? What did they change it from? That sort of stuff is something that those people are always looking to know. So what's going on here? What's the sort of stuff that Calcbench can bring to that issue?
So as you know, in a 10K, companies publish Note 1, which is their summary of significant accounting policies.
Mm-hmm.
And so the first thing is you can actually just go to Calcbench and you can say, let me have a peer group of firms or a single firm. And you can actually just go there and read accounting policies all day if you wish. Very easy. And you see one of these accounting statements right here on the screen. So the next thing people ask, as you were alluding to, is, well, if I have a company and I want to look at how that accounting policy has evolved over time, how would I do that? Well, historically, you'd pull out two 10Ks, go to page 31 on one and page maybe 38 on the other, and start reading. Like, okay, I've got a highlighter and I'm going to go and highlight, well, where things have changed. Well, we let you do that simply by using this button, compare to previous period. So what you see here in front of you is one accounting policy. If you were to click on that button, compare to previous period on Calcbench, you get another screen that looks like this. And it would take you down into the body of the document where there were changes. So the first column is exactly what you saw above, which is, this is now looking at the fair value of financial instruments section of the significant accounting policy. And on the far right column, the third one, that's the same piece of the document from a year ago or from the prior year.
Mm-hmm.
And then what you see in the middle is the difference between the two. And you can actually see that in this particular case, they changed the valuation technique to measure their contingent consideration liabilities. So they actually say here, they're going to derive them going forward using the fair value of their common stock. And prior, they used a different methodology.
So we can actually see what's getting cut, what's getting added, what's getting moved around, all of that.
That's exactly right. That's exactly right.
Mm-hmm.
And then you yourself as the analyst can then, ask questions of management or look to see if you are management. You can look to see how others in your industry are doing it. Perhaps you want to see how a customer of yours is doing something because there may be a credit issue or a credit concern there. You can do that as well.
Mm-hmm. And so I think what's next on our hit parade here was allowance for doubtful accounts. Is that right?
Yeah.
What do you got for us?
Oh boy, I got a lot of good stuff here. This is a really interesting thing. So what you can do, and this is another feature of Calcbench, you don't have to look at a single company at a time. We sort of talked a little bit about how you can look at groups of companies.
Mm-hmm.
And so what we've done here is we've allowed you to pull up a time series for the S&P 500, and we've pulled the metric allowance for doubtful accounts. And you can do this with a few mouse clicks and literally get this data in this tabular format. You can download it to Excel if you want, whatever you want. You can sort it. And then you can do things like, look for big deltas. And so what we've highlighted here on this is a particularly large delta in the allowance for doubtful accounts. And you kind of look and say, whoa, that Envision Healthcare went from 167 million in 2015 all the way up to 2.554 billion in 2017. So from 2015 to 2017, this massive jump. We just highlighted the 16 to 17 jump.
Mm-hmm.
And now you can say, well, look, that is a big jump. It isn't just about identifying the data on Calcbench. It's about digging into the details. And what you can do is you can actually, you see this little trace item here. If you mouse over that particular number, it lets you trace or go back to the source document with one mouse click. And if you were to click on that, what happens is you open another window, and that window will actually show you the details of the particular number.
And, I was going to ask about that because it did seem like a big jump. And I know from time to time, companies will file an inappropriate or a wrong, incorrect data point somehow. And this, anytime you see a number that is clickable, you're going to be able to trace it back to wherever it came from and get the source documentation.
That's exactly right. And in this particular case, you've heard the expression fooled by randomness.
Mm-hmm.
We do not want our users and we don't want anyone in the Calcbench community to be fooled by randomness. There always has to be an explanation for something. And here's our explanation for why this doubtful accounts number spiked. It's a result of a merger that you see there. And so what you want to do is just, before you go and make a claim that something is out of bounds, just go and understand it a little bit and understand that things like this can happen. And there it is. This is why this number is so different. That's not the case all over, but in this particular case, the merger does explain it.
Okay. Now, the next subject that we had were going to be roll forwards and warranties. And I know that Marc Siegel had mentioned that in his discussion earlier, and you were eager to address that subject. So what can you tell us here?
Yeah, so with respect to roll forwards and warranties, we have yet another example of that. And so what we're looking at in this particular case is an example of Boeing Corporation, and there's nothing there's nothing fishy about this example at all. It's actually perfectly legitimate. But these are kinds of things, warranties especially, are the kind of thing that people track over time, especially in a big manufacturing type environment, whether you're a heavy equipment manufacturer like a Boeing or a Caterpillar, John Deere, etc. These things can accrue over time, and you want to take advantage of the fact that this data is available to you now in a digital format. Historically, users of data like warranties had to literally dig through the documents. And I'm not talking about history 25 years ago. I'm talking about history 5 years ago. I walked into a client's office a couple years ago, and he had a stack of 10Ks on his desk because he was looking for warranty accruals over time. And my jaw dropped. I said, how is this possible that you can't get this information? And he looked at me and said, there's no data vendor that provides it. And we looked at him and we said, well, we have it here. And so you can actually go in to a footnote, just like we're showing you here, the liabilities and commitments and contingencies footnote for Boeing, and you can pull out a warranty balance right there at $1.2 billion for 2017, and compare it to the prior value here. And this is an example of what you get at the beginning of the period, what you have at the end of the period, and what the change is intra-period. And so from here, you can do all kinds of things. You can just go and ask of the peer group what it looks like. You can go and build this directly into your model you see that little export tooltip there. Drop this into Excel. You can even go and build an Excel model directly from the tooltip that you'll get when you mouse over this data. It'll tell you exactly how to do it. So we've built a tool that allows you to take this data and just make it actionable immediately.
And now, next slide up, we wanted to shift gears to some accounting standards, and I think Marc and I had touched on those as well. First, we were going to look at revenue recognition. and how companies are implementing that new accounting standard for revenue. And for anyone who may be unfamiliar, the new standard for revenue recognition went into effect at the end of last year. So this year's filings are the first we're seeing of how companies are actually disclosing any changes to the nature and timing of their revenue. So what can we see with the data that Calcbench has?
So we've had some folks go back and look at this quite extensively since the standard came out, and we've had a number of cases where people have come to us and actually asked us, what do you guys see in the data? And there are a couple of examples that just sort of jumped out at us with respect to this topic. One of them is with respect to this company that you see here. You can see General Dynamics, and you can see that given this is a difference in the way companies book their sales. It's really that simple. And so the first thing is, again, you go to Calcbench, you can go and do a simple search on revenue recognition, the actual text string revenue recognition. You can also do it on ASU 2014-09, which is the FASB codification for the accounting standard for revenue from contracts with customers. You can search for revenue from contracts with customers if you want. Many, many different things. And what you'll get is access to this footnote, and it'll tell you, for example, so if a company were to choose a full retrospective method for recognizing revenue versus a modified method for recognizing their revenue, you'd be able to find it in their significant accounting policy or in this section, the adoption of the topic. And what they're supposed to do at this point is tell you, based on how they've decided to recognize revenue going forward, this is how it would have affected revenue in the past. And so General Dynamics is an amazing, amazing case where, as you see here, their restated revenue from 2016 is $30,561 million. As they originally reported it, that number, which you don't actually see here, but you would see in the financial statement on the company in detail page of Calcbench, is $31.35 billion. So about a $700 million difference in revenue, if I'm doing my math right, maybe 800 million, simply from the way they recognize their revenue.
And, since you mentioned this, I'll just bring it up. It's worth noting, if anybody's ever sort of confused about what is the revenue standard I'm supposed to be looking for, or anything like that, you can actually just do the text search, in quotes, revenue recognition standard, which I have done on Calcbench. And Radical Compliance and Calcbench put out a few analyst reports ourselves last year about, who's adopting it in what way. But there's a whole lot of valuable information you can get that, if all else fails, just like type in the text and see what comes up.
That's absolutely right. And you will be surprised at what comes up.
And our last big subject for this webinar today is the new accounting standard for operating leases. And this is another one Marc had mentioned, that the new standard for operating leases goes into effect at the end of this year for disclosures and filings that we will start to see next year. But long story short, it will make companies bring operating lease expenses out of the footnotes, where they currently are, onto the balance sheet as liabilities. So what does Calcbench already track here, and how can people try and get that kind of insight and intelligence through Calcbench?
So the first thing is, this one sort of hits at a very big, it's a big topic for us. We've been interested in this topic for a long time. Every year we publish a little report, and it gets progressively better as we move through time about how the impact of putting operating leases onto the balance sheet, what that'll do to balance sheets. And some of the numbers are quite large. And in fact, they're remarkable. So what you see here is an example, and it hits industries in sort of disproportionate ways. Typically, you see it, in places like restaurants and retailing. It's going to hit those businesses the hardest.
Mm-hmm.
And so you see here an example of the operating leases for Chipotle. So Chipotle is a restaurant that most of us have been to. And when you go and you look at their balance sheet, you'll see, oh, wow, they have a very strong balance sheet. It is one that has assets of somewhere in the neighborhood of $2 billion with liabilities of about 700 million, somewhere in that neighborhood.
Mm-hmm.
And so you kind of say, okay, well, look, that's 1.3 billion in shareholders' equity or book value to a business. That's not bad. But what you don't see in that 700 million in liabilities is this, the $3.9 billion of minimum lease payments that they're supposed to be making, through the life of the contracts that in some cases run, what it says here, 30 to 40 years. So at least for the ground leases. So the new standard, as we understand it, will require somebody to run a discount function over this and to put this number onto the balance sheet as a liability. However, they will then also be required they have a right to use the asset, i.e. the store,
Mm-hmm.
or whatever it is that they're leasing. And so that will go onto the balance sheet as an asset to offset the liability. So these balance sheets that look relatively small will get larger in a lot of these cases. So in Chipotle's case, we expect the balance sheet to grow significantly. So to give you an idea, that this number, this 3.9 billion, even if you discount it using, traditional discounted cash flow methods, it still represents about a 3 or 4 times growth in the current total liabilities.
Yep.
So these are some big numbers, and so we have a report on our website that you can just go and get for free. It's just called Operating Leases: What Lies Beneath. So if you just go to calcbench.com/research, you just go grab it and read about all the other companies that have leases. So what we did was we tracked a couple thousand companies and said, okay, if these companies put these leases, operating leases, back onto the balance sheet, how will it affect their liabilities? How will it affect the balance sheets? And so we built a report, and then all of a sudden, my colleagues here said, hey, you know what? If these numbers are going on the balance sheet like this, it likely means that the companies may actually be able to take an impairment if the asset is not performing up to what we expect it to be performing.
Mm-hmm.
And so we kind of scratched our heads and said, oh my gosh, that actually has a potential impact on the income statement. We don't know this for sure, but our conjecture is that going forward, sometime you're going to see companies, this thing's not quite performing the way it should. We're going to take an impact, and it's just an impairment to the income statement that will affect earnings because it's an unexpected expense. And it's one of these things where you kind of may see people throwing the kitchen sink in if it's not quite the quarter that they expect or the year that they expect. Maybe they'll throw in a little bit extra boost to make it appear a little bit worse, so that next year things won't be so bad, because this isn't a cash hit. It's just sort of a hit to net income.
And I can't help but think, putting on my old compliance hat here, that a lot of what we're talking about right now is definitely of interest to financial analysts. But for anybody out there who's on the corporate side, corporate controllers and whatnot, don't forget that your auditors are going to be looking at internal controls around what these assets are and all the other fun stuff that you already go through with inventory or derivatives or anything else. The total scope of what might get audited is also going to, I don't know, be affected somehow. But how exactly? We're not quite sure. How much? We don't know. But the data is going to be out there, and it's just something else for anybody on the corporate side to think about. This has implications for you too.
That's absolutely right. I mean, Mark alluded to it. You're alluding to it. We again, you're right. We don't know specifically, but when we look at the data and when we put it through the sausage machines and we turn the crank, these are the kinds of things that come out. And we kind of, when some of these, you see some of these numbers, you kind of just, wow, you kind of stand there in awe of them. Like, wow, I had no idea that. I knew it was large, but I didn't know it was this large. And so that leads me to the slightly modified area here, in which you see as well, a lot of the SEC has now mandated that companies that are IFRS filers, that is, you can think of international companies that trade on the US exchange, are also now required to file their financials in XBRL. So that means that Calcbench benefits by getting more data. And so a company like Anheuser-Busch InBev now also has to file, and so that means that we've got their data too, so we can tell you about their leasing commitments going forward. So that's a good thing. So in general, we're not making a statement as to whether something is good or bad. We're just letting you get the data faster so that you can make that judgment for yourself. That's something I want to be very clear about.
Sure. And so Pranav, this is pretty much all the time we have for this webinar, but before you bid us farewell, just give a shout for if anybody has any questions, wants to sign up for a trial, anything like that, how do they get a hold of you guys?
So they can email us, that's us@calcbench.com, right there. They can follow us on Twitter, send us a direct message on Twitter @Calcbench, or they can just come to calcbench.com and sign up for a free trial. It's quite, it's meant to be very, very easy. So any of those three methods can get to us. And as well, on our homepage, we have a little chat function that's got someone on there during US East Coast business hours, so you can reach out that way as well. So there are 3 or 4 different ways to get to us.
All right. Well, in that case, Pranav, you covered a lot of ground for us, so thank you very much for your time.
Thanks, Matt. Have a great day.
And again, everybody, that was Pranav Ghai. He was co-founder and CEO of Calcbench, walking us through some of the ways that Calcbench can help with your financial analysis needs. Earlier this webinar, we were also joined by Marc Siegel, former member of the Financial Accounting Standards Board, and he was talking with us about his views on some of the current issues in financial reporting and analysis these days. And as Pranav said, if you do have any questions or want to sign up for a free trial, he and the rest of the gang at Calcbench would be happy to hear from you. So just drop them a line at us@calcbench.com. And that is all for this webinar. I've been your host, Matt Kelly, editor of RadicalCompliance.com. That's it. Thank you all for listening, and I hope you have a good day.